It's Michael Douville from sunny, beautiful, gorgeous Scottsdale, Arizona, and it is Friday, April 21st, 2017. A couple things I want to bring to your attention today. I do think that the economy is unfolding pretty much as we thought. I think that we probably have a much tougher economy looking at us later in the year, probably fall. I think that we're probably going to have a pretty tough economy. And at the moment, we are out of the market for purchasing properties. We're selling anything that we think is marginal. Anything that was scheduled to be sold should be sold now. And we're buying very selected things. So we want to make sure that what we buy has a margin of safety to it, so that we buy pretty well. We're still looking for things to cash flow. Our rentals and our properties are doing exceptionally well. We've had very strong appreciation. We've had great cash flow. Our rents continue to go up. I'm just finding it very difficult to find properties that are that fit our criteria. So there's still some around. We're still looking at them, but nothing like what it was. Which leads me to think that we're approaching probably. We've talked in the past about we may have one, maybe two corrections in an ongoing bull market. I think we're coming up to a correction pretty quick here, and I think we just need to be cautious now. When I say cautious, interest rates are still very good, and we've had a little bit of a bonus in the last couple of weeks because interest rates have actually come down a quarter point or so back into attractive range. So you might consider refinancing anything that you haven't refinanced already. You might start thinking that maybe you're going to get a break and get it refinanced. And if we run across anything that's of interest to us, we want to make sure we get our cash flow analysis done. And if we can leverage it, we're all for it. I think that at this juncture and looking 4, 5, 6, 7 years, I think I'd much rather put the risk on the note holder than on us. So we're more than happy to take financing really under 5%, which we can get. I think is just phenomenal. So we're really pleased with that. I think we'll find it impossible to get in 2 or 3 years from now. Now, that being said, I think prices will be better. So you're in this dilemma. Should we go ahead and finance now, or should we wait? Well, if you're paying cash, then certainly go ahead and wait. I think there's nothing wrong with waiting for a year or so and see if we can't get a little better prices. If you're paying cash, of course, there you have this dilemma of what are the interest rates going to be, and my model shows interest rates higher. So and interest rates are fairly conservative level at this point, so why wouldn't we do that? So if you're going to buy now and leverage, now it's time to do it. If you're going to pay cash, then let's wait a little bit. So I think that things are slowing down as we had planned, just as we had forecast. I had a client call me and said that their long-term tenant had lost their job, that the wife lost the job, and that they're 2 weeks behind on their rental payment. Well, 2 weeks behind, shame on us. We shouldn't allow that to happen. Here in Arizona, rent is due the 1st. It is late the 2nd. We process serve right away, and within 5 days we're into the courts. And in Arizona, they can be out in 21 to 24 days, just depending on the calendars. So we get right on top of these things so this doesn't happen to us. But this happened to them. It's a long-term tenant's been with you 4 or 5 years. You kind of feel bad for them because they've performed so well. But when he talked to his property manager, the property manager said, look, this is not an isolated instance, and we are having some trouble. This is in Tucson, Arizona. So, it's outside my marketplace, but nonetheless, it's still within Arizona. Arizona's generally pretty good. So it's a non-confirmed item at this point, but it would certainly cause concern for a caution. So we want to take a look at that and make sure that if this is something that's happening, we're more concerned with the quality of the tenant rather than how much rent we're going to get at this juncture. So if we're looking that maybe the economy is going to slow down, we want to start looking at those people who have recession-proof jobs, work for the government, work for the hospitals, they're doctors, lawyers, people that have pretty secure jobs. Two people working it, so we get that cushion. Much rather push the envelope on getting a better tenant than on getting more money. So at this juncture, we want to make sure that we're protecting our base at this juncture. Now, again, I don't mean to preach, but you really need to talk to your advisors about an exit strategy in both the bond market and the stock market. Bond market is it's a time bomb. If interest rates are going to go up, you are going to lose money on your bonds. That's just the fact of life. So if you're unfortunate enough to catch the very low in interest rates, which is 1.6%, I think that was last July or June, they're at 2.3. They went up to 2.6. So you would have had a pretty significant loss already, 9.5%. So you probably would have lost maybe 6 or 7 years worth of interest carry in less than 1 year. And I think this is going to continue. Nothing goes up in a straight line, of course, but I do believe that we're looking at much higher, significantly higher interest rates down the line. So you got to get out of the bond market. These long duration bonds, I mean, if you're in a 30-year bond or long-term bond market, you really have to talk to your advisor and see if at what point do you pull the plug as an exit strategy for yourself. Now, here again, we're looking at real properties, and again, my forecast and my predictions is that we're going to see a shift from financial assets to real assets. Real assets being things that you can touch. Agriculture, forest products, minerals, mining, gold, silver, oil, gas, iron ore, aluminum, and all those things are components of single-family homes. So if those things start going up, you're going to see the cost of single-family homes go up. And I think that's part of our prediction is that we're going to see prices go up, but not for 5 or 6 years. So we're actually accumulating for the early 2021, 22, 23, and we want to put our portfolio and look then. And so in the meantime, we are just strictly taking cash. We are just strictly farmers, just taking a crop. We're not going to be selling anything, so that's what we're waiting for, and we're accumulating for that. So we're going to have a buying opportunity coming up pretty soon. I think we're heading into this correction again, and I think we need to keep our powder dry. And I think some of that capital should be deployed from stocks and bonds. Stock market has just gone crazy. People like Martin Armstrong, who are just brilliant, think that market's going to continue. Yeah, it might. It might. It makes perfect sense for what he's saying is that Europeans and people from other parts of the world are going to take money out of their local economies and try and get into the United States because it's the best economy in the world. And of course, going into Dow and the S&P would make perfect sense. And a lot of these guys are more concerned with return of their money, not return on their money. And a lot of them are concerned if I got 60 or 70% back, I'd be happy with that. So that's one scenario. The other scenario is, of course, if the economy gets so bad, the stock market could easily drop 50, 60%. I mean, that's what it's always done in the past. So, it's just dropped radically. So, my age, there'd be no way I could withstand a 50, 60, 70% drop in my portfolio. I'd be in real trouble. So you need to really talk to your advisor about that. You certainly don't want that to happen to you. And if there's a possibility of that, then no one says you have to be fully invested all the time. It's just not possible. So here again, I would say there's a shift from financial assets to real assets. That's really good for housing. We have an increase in rents. Here in Phoenix, we do not have a bubble. We had 85,000 new residents last year, and we only built 21,000 units. We actually have a little shortage. It's one of the few places around the United States that you actually have a little shortage of housing, and our rents continue to go up. It's a little difficult to find a good rental property. It's pretty tough, and the prices are high. And that, for that token, when you go to buy a rental as an investor, price is a little high. So we have to really kind of bear that in mind. So once again, we think that Maricopa County here in Arizona, I'm not talking about other parts around the country. I'm not talking about Mishawaka, Indiana, or South Bend, or Kankakee, Illinois, Pocatello, Idaho. I think right here in Phoenix, Arizona, we're the #1 county in the United States for growth, Maricopa County. And I think we'll continue to be that. If not one, we'll be 2 or 3. So we're going to be in the top 3 for the next decade. So really a good place to park your money. So I think we're safer than anywhere. I'm not necessarily saying it's safe because we learned that in 2008, 2009, nowhere was safe, but certainly safer. And I think that looking forward, we're going to have a pretty big bull market outside outlying years around 20, 21, 22, 23, and 24. I think we have a real good opportunity to sell whatever we have. So buying opportunity coming up. I think you really need to talk to your advisors and your financial advisors as to an exit strategy, how we're going to do this. Maybe a little asset allocation change. And you are welcome to always call me. We're here in Greater Phoenix, Arizona, Scottsdale, Arizona. You're welcome to call me, and we can put our heads together and come up with something. So listen, my very best to you, and happy trading, and stay the course. See you later. Bye-bye now.